Today, I wanted to look at life insurance. You may have heard a lot about life insurance, but not aware of the different options that are out there. It's very typically misunderstood concept just because there's so much information. But I wanted to take that time today. I actually posted a blog a few months ago, which I'm going to share the link to at the end of this video, that you can check out and read more about the different features and benefits and the options available. But just to go over with you today quickly, there's several options out there. First off, life insurance, if you may not know, is basically a type of insurance that you pay into to provide a lump sum benefit to your named beneficiaries, typically your next of kin, in the event of your death. And it's used to cover main things being financial obligations like death, mortgage, final expenses, that sort of thing. That's the main essential concept of life insurance. But behind that, there's many different options available depending on the need and the type of coverage you need. So this article here I posted in February, which I'm going to again share with you later, kind of summarizes it in a nice, neat fashion. There's essentially two types of coverage you would be looking at for life insurance. There's the temporary and permanent. Temporary is basically for things that are temporary, essentially in temporary nature. Typically, these would include death, loans, children, education, items that are temporary in nature, that they aren't there forever, but they are needed to provide for a certain number of years. Once that time has expired, that need is no longer there, and so you don't necessarily need insurance for that particular need anymore. And that's where something like term insurance would be ideal, because term is a form of life insurance that is for a specific number of years. They come in multiples of 5 or 10 years, range from 10, 20, 25, etc., all the way up to even 100, which I'll get into shortly. You can choose the type of coverage, the coverage amount. The price you pay, or the premium you pay, basically is determined by the amount of coverage, the number of years, your health, and your age. Once you've applied and obtained that coverage, you pay that premium for that set number of years that you've chosen. And then after that, you can decide what to do if you still need the coverage beyond that. But again, typically this coverage is temporary in nature. It's meant to only cover you for a certain number of years until you no longer need the coverage. This is also known as is the most common and the most plain vanilla type of coverage out there. There's no frills, no other added features and benefits to it. You simply are buying coverage that provides you a fixed amount of money upon your death, and there's no additional features associated with it. The other type of coverage is permanent, which essentially means it's coverage that you have for your entire life. It never expires. It lasts your entire life. You have no need to ever consider renewing or canceling the coverage, because the purpose of the coverage is to provide it for the rest of your life. And this is typically used by individuals who want to cover for final expenses, because that need will always be there regardless of your situation. If you have an estate that you've built up that you want to pass on to your loved ones, you may be subject to potentially taxes and probate and other fees. And so the larger the estate, the larger the fees you probably will be subject to, and you want some form of insurance to cover for those fees so that it doesn't eat at your estate. you're essentially shifting the costs onto the insurance company instead of paying it out of your own estate. This is very key if you own a lot of real estate or a family business or something where you don't want any of the value to be eroded through these fees that I mentioned. Business owners also use a form of permanent insurance as a way to pass on their corporation that they may have set up or other assets that they have in the company to the next generation in their family if they want to continue the business, that sort of thing. But basically within permanent, there's 4 types of insurance. There's the term 100, which is similar to the term, except that it's for your entire life, but it's similar to term in the sense that it's plain vanilla insurance with no features or bells and whistles added to it. It provides you the insurance coverage for the rest of your life. It would be, in terms of cost, the next highest premium in terms of coverage compared to term. Term being the lowest, then term 100, and then the last 3 would sort of be the highest in terms of premium payments. Again, this type of coverage is ideal for permanent needs like final expenses and estate planning, and ideal for those who want some coverage for their life but don't care for the additional bells and whistles, who just want that assurity of having coverage for life. With term, going back to term, again, if you decide to continue coverage beyond the term that it is for, you have several options. You can cancel it if you feel you don't need the coverage. You can reduce the coverage and renew at a higher rate based on your age at the time of renewal, or you can convert it to one of these other permanent policies options that you have here. The next, going back to permanent, the last 3 are the types of coverages that do have the bells and whistles of that I mentioned before. Basically, the bells and whistles being an investment component with the possibility of cash surrender value. So cash surrender value essentially is sort of like a refund if you cancel the policy after a certain number of years. The way it works is when you pay premiums into these types of policies, universal, whole life, or hybrid, part of the premium you're paying is being invested, and part of the premium is covering the cost of the insurance. The part that's going into the investment vehicle is tax deferred and is building up over time. After a certain number of years, you have the option of canceling the policy if you determine you no longer need the coverage for whatever reason. Perhaps your needs have changed. This is called cash surrender value because they do provide some money back based on the value and growth of the investments. The term policies, including the term 100, don't have that feature. So if you cancel or the policy at any time, you don't get any money back because you had that coverage during the period that you had the coverage. So the insurance company was insuring you. So there's nothing to be returned to you in those cases. With these types of insurance, universal whole life, hybrid, there is some money that you could get back, which essentially is the money that was invested beyond the money that was covered for the cost of insurance. With the main difference between universal and whole life is the bearer of investment risk. So with universal, you bear the risk of the investments and basically the performance of the underlying investments. You choose between the selection offered by the insurance company. Typically, they are index funds linked to the market, and it would be based on your investment profile that you determine when you initially apply. With whole life, the insurance company takes on the burden of managing the investments on your behalf to ensure that you are getting the targeted death benefit amount that you chose at the time of application. With whole life, you don't have as much flexibility in terms of overfunding the policy, which basically means paying more than the minimum insurance to enhance the growth of the underlying investments. When you apply with whole life, you determine at the start how much you're going to pay, and that's you're essentially stuck with that premium for the rest of the life of the policy. With universal, you can choose how much to put in beyond the minimum required premium for the insurance coverage. You can increase the amount to up to a certain limit determined by CRA. And the more you put in, obviously, the more potential investment return and accumulation you can have in the universal life. But the risk of the performance is on you, of course. Another key feature with both universal and whole life and even hybrid is the ability to borrow against the policy. So you have the ability to take some of the cash out without actually cashing out the policy if your policy grows to a certain point and you determine you need some extra money. This could be a good way to fund any short-term emergency needs without necessarily canceling or cashing out the policy. You can actually borrow against the value of the investments in those policies. Hybrid is essentially a mix of the universal and whole life, where you have a certain minimum guaranteed benefit the insurance company provides, but you also have flexibility in how much you can fund and put into the policy. So you have a little bit of both. In terms of pricing, whole life is the highest premium of of all of them, just because it basically requires the insurance company to manage the investment risk. Universal being the lowest of the three, whole life, hybrid, and universal. And then hybrid is sort of in between whole life and universal. And that's just, again, because of the investment risks that are involved and who bears it. That determines the price. A lot of business owners use this vehicle as a way to invest money that they've retained in their corporation in a way to manage not only estate planning, but exit strategies for their corporation. But it is applicable to individuals who have built up an estate and want to pass on a certain amount, whether it's through their heirs or to a charity, that sort of thing. So all of this can be applicable to both individuals or business owners. This is, again, just a quick summary. I do suggest you go through my blog to read up on the details of each, and please subscribe to my blog as well as this YouTube channel, and share with your friends and family as well. I do appreciate your time, and let me know if you have any questions on this or other topics. Thank you very much.